Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys!
It's November 23rd of 2018, episode number 3. I'm Patrick Ceresna.
And I'm Kevin Muir. If you're tuning in for the first time, thank you for taking the time out to join us. The Market Huddle is a weekly show where Patrick and myself get together over a couple beers to talk about the week's market action, making sure to keep each other's feet to the fire and have a little fun in the process.
In this week's episode, we're going to touch on the most important things that happened this week, which is asking if the Fed has finally triggered the global economic slowdown.
In our This Week in Trading History segment, we will discuss the market closure after the JFK assassination. And for this week's WTF clip of the week, we're going to discuss James Cordier and the disastrous implosion of his optionsellers.com hedge fund.
And in the Tales from the Trading Desk, we're going to look back at the Battle of the Titans, Ackman versus Icahn over Herbalife. And at the end, we're going to touch on the 5 most important things all of us need to watch next week. Let's jump right into it. Kev, who's the sponsor this week?
Well, this week we're fortunate enough to have a sponsor, the Sleeping Giant Brewing Company, who have sent us the Northern Lager beer. So let's crack these babies open and see what they taste like. That's really nice, actually.
Yeah.
The Sleeping Giant is a very famous Canadiana, again, another Canadian kind of theme for our beer, and it's actually a very famous formation on Lake Superior, for those who don't know. And Lauren Harris, which is one of the famous Group of 7 artists, he was famous for painting lots of Lake Superior scenes, and it's actually very fitting that we're choosing this for one of our beers today.
Kevin, let's get to the housekeeping disclaimer. Let's get it out of the way.
That's right. I have to do my legal stuff, so here we go. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. The Market Huddle may cause the following symptoms: itchy rashes, full body hair loss, projectile vomiting, gigantic eyeball, the condition known as hot dog fingers.
All right, Kev, I think that's a little off script, but let's get into the top stories to this week. Kev, let's dive right into it. What is the most important event of the week?
Well, by far and away, I think the most important question investors should be asking is whether the Fed has finally engineered a global economic pause that we've been looking for.
Absolutely. You know what? That's exactly what has been a narrative that we've been thinking about all years, because one thing that we've seen is the S&P 500 has not been the chart that's been reflecting what's been happening around the world.
You're absolutely correct. And so let's just recap what's been happening is that the Fed has been raising rates for the past 3 years. They started in late 2015, and here we have the chart that shows 3-month LIBOR, which is the London Interbank Offered Rate.
So we started near a quarter point.
That's right.
And then the chart is basically showing that we have now on the 3-month LIBOR hit about 2.70.
Right. So we have 250 basis points of tightening that the Fed has approximately done. During that whole time as well, they've gone and actually reduced their balance sheet. So their balance sheet was $4 trillion. 4.5, and they've knocked off
to about $4 trillion.
Yeah, and so
about half a $1 trillion.
That's right. So between them raising rates and actually reducing their balance sheet, something that has never been done before, by the way. And I remember James Grant talking about that no central bank has ever successfully reduced their balance sheet after quantitative easing. So the Fed is so far being one of the few, or being a kind of a unique central bank that way.
But I would argue that you have to look at things from a global interconnectedness, because the fact that Japan and Europe were printing allowed the U.S. to get away with this. If the U.S. was shrinking their balance sheet and on balance the other two central banks were already neutral, I think we would have seen a little bit of a different outcome, wouldn't you think?
Well, that could be, but the reality is they're doing it, and this has surprised the market participants because a lot of people thought that we could never get here. But the interesting part is, during this whole period, the S&P has actually been rising, and it's been the market that's been the strongest. And for the longest time, many market participants felt that the Federal Reserve's hawkish monetary policies were actually causing the strength in the stock market.
There's been an argument, though, that as the U.S. dollar has been strengthening, it's because there's a general demand for the dollar, and the dollar being safe haven, and that money subsequently is finding the stock market and therefore driving the stock market, while the rest of the world is getting that money, the liquidity reduction on the other side of that coin.
Well, that is correct. That's been the argument. I'm not sure I buy that argument. That's Brent Johnson from Santiago Capital with his famous U.S. dollar milkshake theory, and that all of the capital is being attracted to the U.S., and this has caused the U.S. stock market to rally during this period when the rest of the stock markets have actually been falling. And so if we go look, this first chart shows the S&P 500 from year to date, and you'll see that it's basically unchanged. But when you go to the next chart, you'll see that when we add Europe, it's gone and it's down 9% on the year.
Absolutely.
And then when we go to the next one, you'll see when we add the
world index,
the world index minus the U.S., it's down 12.5%. And we keep going, and we add Asia, and we see 13%. That it's down 13%. And then even worse is the emerging markets, which are down 15%. So if we just recap for a second, we look at this chart, we'll see that the U.S. is unchanged on the year, or down slightly, and the rest of the world has been suffering greatly.
Now, I have to ask you here, I guess this is about your starting point, right? Because
these are year-to-date, so we're just looking at the year-to-date returns of these assets.
No, this is actually 2 years, right?
Oh, you're absolutely correct.
Right. So because when I pull up here, let's say just the top to bottom on the emerging markets, so let's just use the EEM as a very simple benchmark. We can identify that there's been, since the February peak, a 28% decline in the emerging markets. So you're actually, I think, being very generous by only calling this a 15% decline.
You're right. I did make a mistake. Those are basically almost 2-year charts. They're a little more than a
little
year,
less.
A little less than 2 years.
Yeah.
But the one thing to look at the chart is to realize is that until October of this year, the U.S. stock market was rallying. It was only 2 months ago that we were actually sitting at all-time highs for the S&P 500.
Right.
And during this period, we had all sorts of market pundits telling us how the hawkish Fed was good for the stock market, how all this was terrific, how Trump's trade battles didn't matter, and there was all sorts of bullishness. And meanwhile, the Fed was desperately trying to tighten monetary and more importantly than monetary conditions, they wanted to tighten financial conditions. And this was the problem, that as they were raising rates, the U.S. stock market was rallying, and that actually made conditions looser. In terms of financial conditions were looser, and they were worried that there was another bubble in the making. So they were concerned about the rally in the stock market. And so I kind of laugh and say they put their fingers in their ears and said, nah, I can't hear you guys, and just kept raising rates regardless of the pain that was happening in Europe, Asia, emerging markets. And even though the U.S. is the central banker of the world, they just said, okay, doesn't matter.
I'm gonna interject because
sure.
I want to sound a little bit liberal, and I'm going to say let's blame Trump for a moment, because one thing that he did with his tax cut was to spur a massive repatriation of capital, which spurred on historical levels of share buybacks. And I remember reading, I think it was a Bank of America piece. Don't hold me to that. I'm trying to remember, but I'm pretty sure it was a Bank of America piece. But they were basically showing that at Bank of America Merrill Lynch, that the only on-balance net buyer in 2018 has been the share buyback desk, and that the institutional client, everything has been either flat or if not even in distribution along the way.
Well, that very well could be, but Powell was sitting there looking at financial conditions, and he didn't care why it was going up. He was just worried that there was a bubble in the making, and he kept raising rates.
Okay, but now when they advertise a dot path,
yeah,
I feel that from a credibility perspective, they can't justify redrawing or changing course. Because now tell me if I'm wrong on this view, but the one thing that central banks and governments in general have is that people gain a lot from sentiment, from the views of the leaders that they put in charge of this. I mean, if everything is chugging along and everything looks healthy and you have Trump saying the economy is solid and growing, wouldn't it become incredibly concerning if suddenly the central bankers you guys are missing it, we can't raise anymore, shit's about to hit the fan? Like, I think that
but it was the opposite, though. Don't forget, they were trying to convince the market to raise rates more than the market believed that they would. The dot plot has been above the market the whole way along. The Fed has been pushing it up. But not only that, the Fed has been more hawkish through their projections than the market has been, because the market has rightfully recognized that we've never had so much indebtedness. We've never had so much corporate debt. We've never had all this. And that in fact, our economy is less able to handle the increases than we ever been able to handle. Now, the thing about it is that Trump, with his fiscal policy, and don't forget, this was a pro-cyclical fiscal policy at the end of a already large expansion in terms of time. They caused it so that the Powell was forced to actually be more hawkish than would have otherwise been the case.
Sure, I'll buy that argument.
Right.
But when you're referencing the idea that the debt is such a huge burden, you're making me think that we're all turning Japanese. This is an argument that me and you have had many times, and this is what puts me far more in the deflationary camp, while you've always taken the other side of my coin. The whole argument here with the mass amounts of debt and the impact of the interest rate, to me, with a managed economy thing, I think that there's plenty of room for interest rates to once again be heading much lower if this global economic slowdown's for real.
Well, as you mentioned, I am a long-term bond bear, but that's predicated on my belief that central banks will be accommodative. If we have a central bank like the Federal Reserve that is out to protect the value of the currency by raising rates and actually keeping real rates fairly high, then I will join your camp and say that we're gonna have bond yields much lower. And I know that seems perverse, but if you think about it, as a bond investor, what's your worst enemy? The worst enemy is inflation. And the reason that ultimately I'm such a bond bear is that I think that central banks, because of the large amount of indebtedness, will be forced to cry uncle and actually lower rates more quickly than in the past. So let's go back and think about Mario. It wasn't Mario Draghi. It was the guy before Mario Draghi. Who is that? Trichet. Trichet tried to raise rates in 13 and 14. I can't remember exactly when it was. But it was during the time when the U.S. was doing their quantitative easing. It was in the aftermath of the great financial crisis. And, the Americans were doing quantitative easing, and the Europeans were getting nervous. They were looking at this and saying, look at all this debt that you're doing and that you're monetizing. This is going to be a problem. We have to raise rates. And they raised rates. He got off a whopping 2 raises.
Yeah.
Before he ushered in the euro crisis.
And the second one, was it not that the market almost immediately responded on the raise?
Yeah.
Correct me if I'm wrong, but I think it wasn't even baked into the cake. I think he surprised the market.
That's right. And it caused a huge sell-off. Now, so I think that the similar thing has been happening in the U.S., but it's just been happening kind of with a little bit longer and a bigger time frame. The central bank, the Federal Reserve, is being very eager to normalize rates as quickly as possible and to normalize their balance sheet to get it down to a more manageable level. So they've been more hawkish than the market has been. And they've been lucky in that Trump's fiscal policy, that pro-cyclical fiscal policy, allowed them to raise rates more than they would have otherwise been allowed to. Because chances are the economy was rolling over at that point, and then Trump came along and gave it kind of an adrenaline shot and a bump in the arm. But here's the question for you that I have, is that have we hit a point where, just like Trichet raised rates into the next the European recession, has Powell done the same in the U.S.?
I think that is a very good question, because what we've seen was the fact that with this rate hike that came in, when he came in pretty hawkish after the last rate hike, and the market almost immediately responded on that. Now, we've already baked the December rate hike into the existing prices, but wouldn't it be interesting is on that December, we're going to obviously be doing a show literally the day after that December rate hike, but it'll be very interesting to see what the market's first response is going to be for them in these kind of market conditions, pressing one more time. But I want to move on, because I want to ask you here, what are we looking at when you're here? You're talking about the Bloomberg U.S. Aggregate Total Return Bond Index. What are you trying to show with this?
Well, what I'm trying to say is what happened this week was, I think that the Fed finally blinked. I think that we hit the point where they realized that they had raised rates enough to cause enough pain, that they were actually at a point where they felt that they had to take back some of their hawkishness.
Okay, no. Let me ask you something, because I'm going to challenge you on this. What U.S. data has made them blink? I mean, look, do you believe that the Fed is looking at the global indices and taking responsibility for it? What is it that in the U.S. data?
So I don't think there was a specific thing that came across, like it's like, oh, this, like the durable goods shit the bed, but like that was just one bad number. So it wasn't one specific thing. I think it was a combination of factors. For one, it's interesting that if you look at the bond market's down over these past 2 years as well. So the bond market's going nowhere. The stock market's going nowhere. The rest of the world's financial assets are all having real trouble. Inflation is no longer a concern, because if you go look what's happened this week. This is a different chart. But if you go look at if we go look at crude oil has collapsed. Yeah. And if we think about why crude oil has collapsed, one of the reasons might be, now, there's lots of people say it's a supply issue, but it also might be a demand issue. It also could be that finally the global economy is slowing and there's not as much demand.
Well, listen, I could see you making the argument that that could be a demand issue, but I don't think so. I think that the crude oil story, like especially when we saw the huge backwardation and then the normalization of that, I just simply think that the front of the curve just way overshot, and now is completely mean reverting the other way.
Well, and it could very well be that you're correct there, but at the same time, go look at the next chart, which is inflation expectations. You can see that break-evens have basically been following crude oil downward. And this is the 5-year break-even rate, which means that how much inflation the market is expecting, and it's collapsed along with crude oil.
Right. So so inflation is collapsing. Then why have we not seen Treasury bonds yet reflect that? I mean, look, it looks like there's bottoms, it looks like there's turns, but we haven't seen any meaningful buying in bonds. But like, if I'm looking here, your inflation expectations here, we've gone from like say 220 down to like 180. All right, so that's a 40 basis point drop. We have seen nothing comparable to that in adjustment in yields. Like, is the market just simply not drinking the Kool-Aid yet, or does it take a while for this to start?
I think it's going to take a little while, but at the same time, I expect the curve to steepen. So I don't think you're going to see the 30-year back up. I mean, like...
Sure, but okay, we're not talking 30-year. I'm talking about just the fact that in general... the inflation expectations have been dropping, yields have been dropping on this much faster than they have been on the actual yields.
Because up until last week, the Fed seemed reluctant to blink. The Fed seemed to be on a course to raise rates no matter what, and it didn't seem like anything would change their views. But I think this week you saw Clarida come out, which is one of the FOMC board members. He came out and said we're much more data dependent. And listen, do I think they're going to raise rates this December? Of course. Like, there's not a chance in my mind that they're not going to raise rates absent some sort of really big issue like geopolitical event or a collapse in economic activity. Right. So they're going to raise rates. What the difference is, and there's a very subtle difference, they were previously on a policy to raise rates at every second meeting, no matter what. And the market, and they were trying to convince the market that this was going to occur for a while. That they were trying to show them the dot plots, look at where we are, this is where we're going to end up. They were trying to tell the market this was going to happen. The market has now realized that they're unable to do this. And it's a combination of factors. The stock market stumbling, the world stock market stumbling, the crude oil collapsing, the economic numbers not coming in as strong as before. And so what happened was the Fed finally blinked. And what they did was they said, we're no longer on that path of raising rates every second meeting. We're much closer to neutral. Yeah. And we're going to be more data dependent. And so does that mean that they might raise rates, in March or whatever it is? For sure. If the economy goes back, they're going to raise rates. Like if the economy bounces.
I thought it was interesting again, it was from a Bank of America report, and they were talking about the threshold levels where they believe that if the markets hit these levels, that it would cause the Fed to pause their existing rate hike cycle. And it was interesting because it wasn't economic data points; they were referencing market data points. They said S&P below 2,500, the junk bond HYG below 80. They were going through a series of these trigger levels where they said if we see these levels broken on the downside, that the Fed. And I thought it was really interesting because they weren't economic data points.
Well, I would agree that that's my next slide. If you'll see. It's the market CDS swap, which is basically the generic price for credit default swaps. And you'll see that this week it really blew out. Wow. It might have been led by GE, but credit spreads are widening. And this is what the
This is corporate, right?
That's corporate. Basically, this is the rate upon which corporates borrow above treasuries or government rates. Right. So it's how much extra premium do corporations have to pay to borrow money.
Absolutely.
And for the first time, we're seeing some real stress in the bond, in the corporate, in the credit area. We're seeing GE blow out. It's trading like junk. There's all sorts of bonds that are having some trouble. There's big redemptions in the ETFs. Things are like, there's no doubt about it that the Fed's looking, and there's enough tea leaves that are showing that there's some stress developing in the system. And ultimately, this is why I think we're going to see inflation, because central banks are still I know you for those who can't, you can't see Patrick, he just like jumped out of his skin. I think that what we're going to find is that central banks panic with their easing too quickly. And I've been shocked, I've been wrong, to be truthful, about how much Powell is willing to raise rates up to this point. But I think you're going to find that on the whole, they're going to, at the first signs of trouble, they're going to start lowering rates, or at the very least stop raising them and maybe go back. So I think the next.
Let me push back. You can. I want to hear your little inflation theory in a second here, but the one thing that I think has to be accounted for is the feedback loop that happens once the boulder is rolled going up the mountain down to the downwards on the other side. What happens is that once these credit problems start to emanate, people delay and things don't get priced in right away, and the foundation keeps eroding, but the prices don't immediately reflect it. And then what happens is it drops, but then it becomes a self-feedback loop, and not 1 or 2 or 3 rate hikes stops this feedback loop that starts feeding on itself.
You mean rate cuts, not hikes? You said rate hikes, but you mean rate cuts, right?
Right,
you're saying
but
that
the rate cuts. Sorry, I meant to say rate.
So you're saying the Fed can't stop it?
No, but the point is that what you're trying to, if you're trying to build me a case that they're going to overshoot, I just think that once shit hits the fan, then this is just going to start steamrolling out of control on the downside.
Okay, so there we go. There's the classic hedge fund. The world's coming to an end. 2008 is around the corner, and you're not alone. And there's some really smart people in your camp, Patrick. Like if you go look, Guggenheim, Scott Minerd said basically high corporate debt bodes ill for U.S. economy. He basically came out last week or the week before and made a huge kind of worry about the amount of debt. He kind of cited GE and said it's just the tip of the iceberg. Another guy that I just love is Paul Tudor Jones. Paul Tudor Jones came out and said we're headed for a global debt bubble and headed for some scary moments ahead.
Yeah.
So now, do you think that Powell and company, do you think that they're not listening to to Minerd and Tudor Jones?
No, they listen to them. But the thing is that the Fed can't flip-flop. Once they make the decision to go from their existing path and change monetary policy, they can't just go, we're going to cut. Oh, no, now we're going to go back to raising. They're not going to be doing that kind of flip-flopping.
Oh, I don't think they're going to zip back and forth. But on the question is, do you think that it's too early for them to be going and pausing? Let's just accept for a second that I'm correct, that they're pausing. Sure. Okay,
I'm not. Listen, I'm not actually gonna push back on that. I am in your camp. I think that the economy as a whole can't deal with these types of interest rates, and so the Fed pausing is going to be something that, on aggregate, is the outcome. The thing that I'm just saying is that I don't believe Powell will stop this rate hike cycle until they have absolutely no choice but to switch back to a full rate cut cycle.
Okay, so you think that they're going to do what they always do, which is raise too much and cause a financial crisis.
I love how some people call it policy error, but the thing is that when the Fed has been raising into a recession, 10 out of the last 11 recessions, that's not policy error. They just repeat the same thing over and over again.
You could be right. I would argue that you're going to find that they're more likely to stop raising into the recession more quickly because of the kind of institutional memory of 2008.
Okay, but now let me just touch on 2008 then. What I want to point out is that they did. When was the last rate hike? Wasn't it like early 2007 or late 2006 when they stopped raising?
But
let me pull up the chart.
But don't forget, in 2006 or 7, when Bernanke was saying there's nothing wrong, they were very slow to realize the amount of pain that was occurring in the financial market.
No, but that's not the point I'm making. The point I'm making is that they stopped. They paused, and okay, so here's the Fed funds.
They paused, and they should have cut way earlier, and they were slow to cut.
So
don't forget when
we're showing a chart
Kramer
here
going crazy.
It was it was actually what is it showing here? August 1st of 2006, and they were already done. So they were done the rate hikes in 2006. They stayed flat on the Fed funds rate.
Right, but they raised too high, and it was already clear that there was some problems.
But there's a difference between pausing and cutting. And so when you're saying here that the Fed is pausing, that's one thing. But I mean, the question really that I'm asking is that just because they're pausing doesn't mean that they're going to start cutting.
Oh, and I'm not saying they're going to go and start cutting tomorrow or anytime soon.
And I wouldn't think so.
And it's going to depend a lot. All I'm saying is that they're going to pause earlier than everyone expects. They're going to cut sooner than everyone expects over the long run. Now, I've been wrong that the U.S. is gone, and because of the fiscal policy, they've been able to actually raise rates and withdraw accommodation from a monetary perspective way more than I would have ever guessed possible. Right. I would have never in a million years would I have guessed that we would be here. I thought that they would never, people forget, but there was a lot of really smart people who said the first tapering, the first time that they reduced their balance sheet, the economy was going to crack and that the stock market was going to crack. And yet here we are, and they've been doing it for how long? It's been 9 months or something that they've been reducing their balance sheet, and so far nothing. But and speaking of that, actually, here we go. We can see that there's other guys. It's not just Tudor Jones and Scott Minerd that's having some kind of worries about credit. You see that this is a credit research from Santander that shows that they're doing a home alone. They're screaming that they see all the problems that are coming. But this next chart is the one that I really want to talk about, and this is the amount of monetary tightening.
Right.
Some of the more hawkish kind of hard money people will say, we've only raised rates 200 and odd basis points. We've just started this process. We have to get back to 5%. And I call BS on that because one of the issues...
What are you thinking there?
So the reason I think this is because when the Fed hit the zero bound, instead of going and actually putting rates negative like ECB did, which is just stupidity of the biggest order, you
ruin the trust of money.
Well, it's just dumb. We'll talk about that in another show, but it's just dumb. So instead of doing that, they did quantitative easing. And if you go look, you can actually measure that the amount of monetary accommodation that they put in. You can create what's called a shadow rate, and the Wuxi shadow rate measures it. And if you see that when they withdrew the amount of quantitative easing, that was actually a tightening. So based upon the quantitative easing, they had actually pushed rates down to -2.5, -300 basis points.
Right.
And it was kind of a theoretical one. So when you look at the withdrawal, way back when they did the tapering, and people forget, but Yellen was also, everyone thought that the moment they stopped buying and they started tapering, that would cause all sorts of problem. They've actually been raising rates for a long time, and we're now up to almost 450 basis points of total rate rises. And this is also
so there's the actual rate hikes,
right? But don't forget,
and when they're quantitative tightening, that is also a synthetic rate hike. Is that what you're saying?
Well, no, because once we go back above zero, they don't like the shadow rate becomes the same as the actual rate.
Right.
So they're just measuring when it went below zero, how far did it go below zero based upon the quantitative easing. So I think if I remember right,
So this chart is basically showing that this current rate hike cycle is pretty much of equal magnitude to the ones from the 87, 93, the 99, 2006.
Yeah. So which gives me further proof, or further kind of belief that when the Fed finally paused this week, that we're close to the end of this rate hike cycle.
I agree with that. I think that the recessions are much more likely than not. My view continues to be that the rest of the world is already in some form of a bear market, and many countries are just on the verge of falling into a recession. Because from my perspective, one thing that I've shared with my members all the time at Big Picture Trading is the view that this time it would be the reciprocal of 2007, 2008, which is that the 2007, 2008 was the subprime crisis. The situation deteriorated in the U.S. As the U.S. fell apart, then like a contagion, it spilled to the rest of the world and started a global slowdown. In this situation, my view is that it's a reciprocal. By the U.S. tightening conditions so much and starving the world from U.S. liquidity, it actually has spurred on a global economic slowdown that was going to cause recessions abroad much quicker than you'll see it in the U.S. And on a lag that might be 6+ months or more, you'll see the rest of the world start to show signs of recession, and eventually it will spill back into the U.S. to cause the slowdown in the U.S., but it won't emanate from the U.S. Now, what do you think of that theory?
Well, I think it's a great theory, but then I have a question for you. So if we've hit the point where it's actually spilling into the U.S., and if you agree that we're now hit the point where it's actually affecting both their economy and their markets, and we agree that the Fed is pausing, where do you go and invest in going forward? So if the Fed's on hold Let's just assume.
Well, we go back to what we talked about last week's show, which is that you can go into somewhere in the middle of the curve on Treasury bonds.
So what do you do for stock markets, though? Do you own the U.S.? Do you think that they're going to be the leader coming out of here, or as the Fed?
You want to be low beta, high dividend, high yield, and you want to be defensive, and you want to hold above average amounts of cash. You just want to play defense, have put insurance. You got to have some way. I love that old saying of the one in a bear market who loses the least wins. And so
do you think we're going into a bear market? Like, do you think?
Oh, absolutely.
So you're really bearish. Like, do you think this is the start of a full-on bull?
I've back to my 2018 market forecast video, which I published back in December, almost 11 months ago. My whole theory back then was that 2018 was going to be one very large topping formation for the peak of the bull market. Now, I don't while I will say a bear market, what I won't corner myself into is saying that this is going to be the nastiest, worst one, or this is the going to make 2008 look like it was nothing. Like, I'm not going to. Bottom line, I think that there's a recession coming, and every recession has some form of a equity bear market associated with it. Is it going to be a 25% decline, or is it going to be a 50% decline? I'm not 100% confident to be able to say. There's a lot of things that can go wrong. That's for sure, but I'm bearish.
Okay, so here's what I'll make my prediction that this coming bear market will be less steep than most market pundits believe, and it'll be more shallow, and that the real true bear market won't occur until the Fed loses control of the bond market. So everyone's scared about the stock market right now. I'm not scared of the stock market. I'm scared of the bond market. And that's what worries me, is there's going to hit a point where the Fed's going to lower rates, and instead of the bond market going up, the bond market, especially the long end, is going to go down. And it's at that point that the true crisis will begin, because that will be the point.
Can that be an entire business cycle away, though? Could we go through this kind of a slowdown, an economic recession, go through recovery, and your narrative happens in the next cycle 7 years from now?
Well, a good trader learns to never say never. So
no, I think what your idea is a really big picture idea. I mean, that to me, what you're talking about is a failure of the big super debt cycle, and the bond market reflecting that. But does that have to happen in this cycle?
Well, no, it doesn't. But what I would push back to yours is that I think that the amount of stimulus that's going to be thrown at it by both the governments and the central banks is going to surprise most people to the upside. So the moment things get even a little bit bad, we're going to be shocked.
That's bullish for gold, though.
Well, it's bullish for gold. It's also, bullish ultimately for risk assets. And I still think that this like, don't get me wrong, I am by no means some big, huge bull. Like, I think that ultimately this is going to be a disaster in the making. I just look around and I see more fiscal stimulus. I see more monetary stimulus apart from the U.S. Like, nobody else is doing anything but, like, they're trying, but the reality is their balance sheets just keep going up. Bank of Japan keeps going. ECB, they haven't even managed to taper. They're not even anywhere close, and their economy's going nowhere. To me, I just see more and more stimulus, more and more money thrown at it, more and more cheap money thrown at it. And so ultimately, you might not be bullish on a real basis, but I'd be careful about being bearish on a nominal basis.
I actually am not going to dispute anything you just said, but I feel that by the time that they provide the liquidity that you're talking about, shit could have hit the fan in a really big way, and before that stimulus comes in, if you think about it, the average recession in the post-World War II period is 11 months. So you got to think that let's just go through a hypothetical pretend scenario. Bull markets tend to peak, let's say, 6 to 9 months in advance of a recession. So if, let's say, October was the top of the equity market, then let's say second quarter of 2019 is the global economic recession in full force, right? And now let's say that recession lasts for the better part of 2019. If they start cutting, they're usually cutting 25 basis points at a time, or do you think that they're going to go more aggressive?
Oh, I think that if things got bad, you'd be shocked at how quickly they're going to cut. You'd be shocked at how quickly they'll go back to doing QE. You'll be shocked at the measures they'll take.
You can't shock me with that
no,
stuff.
But I
you
think
can't. No, you know what? I believe that the Fed and all central banks we're in such a late stage of the debt super cycle that they have to do draconian style monetary policy. So I'm not going to be shocked. Maybe our listeners might be.
Yeah, and do not say that I am some sort of just like kind of absent-minded bull that thinks
that's what I was thinking actually.
Yeah, I am not, and ultimately I do believe that all that stimulus is going to make it so real returns are very low. I am not bullish on a real basis.
Yeah, you're just talking the nominal.
I'm just talking on a nominal basis that it's I think you're going to be surprised at how little we go down, because the reality is that we've blown this huge kind of debt bubble, and the consequences of it imploding are so high. And not only that, we know the consequences because we saw them in 2008, and we had a chance to just go and let it go, and they showed that they didn't want to do it.
Yeah, but I mean the establishment always wants status quo. They have to push it as long as they can to keep things the same. It's
a lot different this time as well, because in 2008 they were scared of fiscal stimulus. They're no longer scared of fiscal stimulus. You know what's going to happen the moment that the economy kind of comes and starts to kind of, peter out? They're going to just start, spending on infrastructure, spending on some different things. You're going to be shocked at how much they spend.
I'm going to just encourage all of our listeners, go grab Ray Dalio's newest book on understanding debt cycles, and get to that part where he in his chapter where he talks about pushing on a string, and he talks about the different degrees of monetary policy and the 3 different types of forms, and you'll still realize how many things the Fed hasn't done yet that they are capable of doing when things really get messy. And so I'll in principle agree with you that there's a lot of things. What I'll say to our listeners is going to be really interesting, because we launched this show at probably one of the more interesting times. We're going to get to do the play-by-play on this for the next couple of years, just seeing how this all plays out. I think it's going to be really exciting. Any last comments, Kev?
Well, I really think that the Fed is blinked. I really believe that this was the moment in time when the Fed is taking themselves off this autopilot, and they've gone and they've said that they're data dependent, and we're going to find that the amount of rate hikes they do slows down, and we're going to see both the U.S. dollar go down. We're going to see the short end eventually go down because there's a lot of hikes priced in there, and we're going to see the risk assets and especially commodities get a bid.
So let me ask you a simple question. Yes or no? On balance of probabilities, is there a recession in 2019 in the U.S.? Now, in the globe, I think yes, but in the U.S., is there a recession in 2019?
I think that the recessions are going to be shallow. So if
it doesn't matter. Is there going to be a recession?
I think there will be an extremely shallow one, yes.
Okay, perfect. Let's move on. This week in trading history. So, Kev, this week, back in 1963, was the JFK assassination. And within 30 minutes after the assassination was the New York Stock Exchange market closure, at least temporarily on the event. What do you remember of that event since you were around?
There you go.
Then?
You had to do that one again, of course. No, I was not around. And actually, I have a question for you. What do you think the Dow Jones was at that time?
Near 1,000.
Well, you're absolutely correct. It's a little less than 1,000. So the day before the announcement, it closed at 732, and the day after, it was 711. And what was interesting about that year was that it was actually rallying the whole year. And when you look at the chart, you'll see that the Kennedy assassination ended up being just kind of a blip.
It's almost like a Trump election blip.
Yes, it actually is. Obviously much more serious and obviously much more sad, although maybe some people would argue the same, but you never know. One of the things when I was researching this that was kind of interesting was that I was wondering, because going into that period, you'll see that the stock market was actually going down. And I was like, what's that about? Like, why was that? And it was actually an enormous scandal that had broke on November 19th, a few days before the assassination. And it was American Express and several brokerage houses had secured loans against tanks of, guess what? Salad oil.
What?
And they had proved to be worthless. So it was the great salad oil kind of scandal, and that was causing some worries with American Express. So when you think that there's some problems in our markets, you got to remember back in 1963, not only did they have a president that was assassinated, they had the problems with salad oil that were worthless. It is interesting to see how quickly it bounced back. I don't know. Obviously, you never wish anything like that. But the one thing I do want it to kind of remind people about is that it's been a long time since we've had a geopolitical event of any kind affect the markets. And I was
of that kind of magnitude.
Yeah, well, not just
not from market magnitude, but like an assassination of a president.
Or even just worries about about wars or anything. It's actually been a remarkably calm period, and it's for the younger listeners that can't imagine this. There was a time when you'd get up and you'd find some terrible news, and things would gap down 5% overnight from some geopolitical event. And it's been a long time since we've had anything like that.
Yeah, I agree. Let's move on.
Well, Patrick, it's time for the WTF clip of the week, and there's no doubt what this week's has got to be. So why don't we just roll the tape?
All right, let's do it.
Good afternoon. This is James Cordier of OptionSellers.com with a market and account update for November 16, 2018. Needless to say, the events of this past week have been incredibly devastating for our clients, who I rarely call clients, around the office, and sometimes on phone calls, I refer to our clients as family. On what we call a new client call, I often thanked and told the new client that we were so happy that you were joining our family.
Shut the fuck up, Maffei. You did what you did, you got your money. But no amount I give to charity will help me atone in this business.
In the Wall Street Journal this week, it spoke on and on about the movements in the crude oil market and the natural gas market. It talked about the incredible volatility that cost funds and fund managers and hedge funds their livelihood. This rogue wave that I was unable to navigate has likely cost me my hedge fund. And the reason why I had a hedge fund is because you are clients. I promise you, every day when I woke up and I would check the markets, I was checking for rogue waves. And I truly invested your funds like you were family. I am so sorry that I was unable to manage the rogue wave that hit us this week.
Listen, this is a very sensitive topic for me. I wanted to take this one head on because I would argue 15 of my 20 years of trading, I have been a premium harvester, seller of option premium on quite a large scale. Like that, this is something that encompasses a lot of what I do, and I've always said that it drives me crazy that people give this strategy such a bad rap. But then you look at what James Cordier did here, and you know where people get this impression, right? But it's amazing to me what he did.
Yeah. Actually, before we talk about what he did, can we just talk about the manner upon which he told everybody? I don't know, but if I get my account zeroed, I don't want to learn about it on YouTube. Okay. Yeah. And then and not only that, if you're going to go onto YouTube and do it, and listen, you have to give the guy credit at least for
Owning
taking
it up.
you know, he took it head on, and obviously it's affecting him. And but like, take off the fancy watch and the slick cufflinks and stuff when you're telling your investors that you just lost all their money.
You could take the Rolex off, right?
That's right. You should take the Rolex off and be trying to give it to the customers already. So why don't you tell me, we spoke about this a little offline, and you told me about your 2 principles that you have in terms of selling vol.
which clearly James
Cordier
didn't really follow.
So why don't you tell us about them?
When you're selling premium, you have to be one of 2 things. You have to be either diversified in what you're selling, or 2, you need to be hedged on what you're selling, right? And so taking a massive concentration in one position simply creates too much tail risk. It creates that one event can ruin you.
Yeah.
And like I'm devastated when I see this, like the thinking the people that the lives that were affected by this. I mean, he was clearly okay. So now when I was reading the article on Zero Hedge, they made it very clear in his letter that that he lost control of natural gas naked call options.
Right. So he owned up to that was the position that
in the letter he
Okay, yeah.
basically made that known. But we were just kind of going in, doing some math in our head, trying to figure out what kind of a position did he have to have on to have zeroed out the accounts.
Right. And we figured it was huge.
It had to be huge.
Yeah.
Right.
And
So I'm going to put up the nat gas chart for starters.
Right.
Right.
And while you're doing that, one of the things that after years of trading like a volatility book for a bank, I'm sympathetic because we were always short volatility, so I understand what chasing gamma is about, and I understand the risks that are imposed with this. And one of the things that always scared us was what we just spoke about with the geopolitical risk of the gaps. The gaps are what you can't hedge against. So when I thought to myself, okay, this guy, there must have been some huge gap in natural gas. Because if you have a gap, that's when you really get into trouble shorting vol, because you can't hedge at the discrete points that you see on the chart. You basically, it blows through your stops.
Right.
So I thought to myself, their natural gas must have gapped up, 20%, locked limit, and it moved up and things like that. And then you pull the chart up, and
it traded right through it.
And there's barely any
there
gap.
There was one gap that was basically from 3 spot 35 BTU, and it gapped about 350.
Yeah.
So you're talking about a 15 cent, which was, let's say, a 5% gap higher. But the other price action basically traded straight through, right? There was no period where this was just like a 20% gap.
Yeah, so to me, it's just shocking. And he says that he had rules in place, and I don't know what the rules are, because to me it seems like that you had a market that you could have executed within your risk tolerances.
So let's just go and explain first of all to our listeners what a naked call is. Essentially, a call option is the buyer has the right to buy this underlying security, and the counterparty has therefore the obligation to have to sell it to them if they wanted it
at a specific price for a specific length of period of time.
Exactly. And the buyer pays a premium. The seller receives the premium. Most people do this premium harvesting covered. But when you are naked, it means you're selling the call premium and do not own the underlying deliverable, which is you're taking the naked risk that the price will run away with on you. And so each futures contract is a 10,000 multiplier on natural gas, 10,000 BTU, right? No, sorry.
Yeah, no, you got it right.
No, it's 10,000 units.
Yeah,
and the price is, let's say, $3 BTU. Now
right.
It's 4.5, and so each at the time when he was selling, we went back and we looked. Actually, let's look at the chart. If let's say he was opening the at the money naked calls. This is just a chart of the prices of the nat gas for January contracts.
Yeah, so we just arbitrarily chose something.
Yeah.
And we said, if he was selling something, like at the time, let's go back to the contract just quickly and we'll show where it was. and it was trading at roughly 3.5.
Yeah. So let's say it's 330, 350 was the upper boundary of the zone, right?
Right.
So we're talking about, let's say, this level at 340 is the upper boundary
Right.
of the price.
So
level.
we were saying if he sold something that was slightly out of the money, so
350s.
So we chose the 350 calls, and we said how much would he have gotten for selling those calls way back, a couple months ago when he was trying to do this thing. And so why don't we pull up the chart?
Yeah. So we were looking at it, and so he basically was probably getting 30 to 35 cents.
Right. So that represents.
So he's getting what, 3.5? Let's just 35 cents, $3,500 premium for every one naked call he's selling.
Right. So I like to do it as a percentage of the underlying.
Sure. Go ahead.
So it's 8.5%. So that's what
and that's just over a month of time.
Yeah. So he could earn 8.5%. By
on
selling
gas.
these
so which annualizes very just under 100%.
Right. So actually that's a good point. As we were wondering is what sort of returns was he achieving in this account? It would be actually interesting to see that. Because
Right.
it could be that
you have the natural contango in the natural gas markets, which basically has you rolling these types of option premium. So one of the things we were pointing out is that selling naked calls on nat gas was a lot like being short volatility back in January of this past year, where you were harvesting VIX premium, and eventually just one event creates this widowmaker event.
That's right. And we spoke about this briefly last week about when we were talking about the natural gas versus crude oil trade and the fact that there was such a positive carry in shorting crude oil. And that's implicit in the options as well.
Crude oil and nat gas.
No, sorry, in shorting nat gas. And that implicit carry is also in the actual natural gas, and it's also in the options market. It's priced in there. So shorting those calls was kind of juicing up the actual already natural carry. And so he was doing this and just kind of earning it over and over and over again until it didn't work. And the question was, what sort of he had clients that were, and first of all, you have to understand, it wasn't actually a hedge fund that he was running, because it was a futures account that he was opening, or my understanding, I shouldn't say this, I don't know for a fact, but my understanding is it was futures accounts for customers that he was shorting those calls for them, because they woke up in the morning and got told not only is your account zero, but you owe some money. Yeah. And with a hedge fund, that doesn't work that way. It's you're limited in terms of your losses, and that's all you can lose. But this was actually a futures account that he had discretion over. Which is even kind of crazier that people were letting him do this.
So just to clarify a few more things for our listeners, right? So you could carry, I think we calculate, you could carry a futures contract on natural gas for about 15% margin. So you could, for give or take $5,000, carry this $30,000 futures contract, which is now worth like $45,000 because it's now like near $4.50.
Right.
And so the naked call could be carried for a very similar margin. And so he's turning around and harvesting 35 cents and needing to collecting $3,500 premium and only needing like $5,000 margin to carry this. Like, you could see the lure of wanting to profit from something like this, right? But what's interesting, and what we were asking, how much of these contracts did he have open for him to zero out these accounts?
Yeah, it was huge, because think about it, the natural gas only moved 30-40%.
Right. So nat gas went from, let's just for rounding purposes, we could say went from 3.5 up to $5 at its peak. Right. So we had a $1.50 rise on a 3.5 unit. Right.
Yeah. So that's like 42%.
40%. Right? Let's just round it to 40%.
Yeah. So which means he's got to have like 200 plus kind of percent that he's overwritten on these.
In other words, he took these clients' accounts, no diversification. And
Well, you don't know. They could have been all sorts of negative short vol on some other stuff that also was like hitting the fan at the same time.
Yeah, because all asset classes are being hit right now.
Right, and so
and so clearly, what's happening here is that he was so over leveraged on this, trying to make these clients money. But really, there had to have been a decision. Because, okay, let's say crude oil, the nat gas goes from $3.50 to $4, and he might have been down 40% on these clients' accounts at that moment. But thinking that he can't have
he can't report that
he can't report
20%,
that
30%, 40%.
It's like that story you shared earlier with the trader putting the ticket into his desk.
Oh,
like
that's right.
Like he was like, he just literally gambled with their money to say
He kept thinking it was going to come back.
He was going to come back,
and he did not cover it. So
what if he even doubled down?
Well, we don't know. That's
no. I'm not trying to say I know this.
No, but
like if you're down 40% on the client account, and you think it's going to come back. Do you add to the position?
Well, he definitely shouldn't be, but at the very least, I don't buy his argument that they followed their risk. You know, because if that was the case,
you can't zero an account if you're following
the
risk
only
rules.
reason I would understand that is if you had a gap that was so large that they were unable to hedge. But which means, like, if they're trying to tell me that they followed their risk and that they couldn't do it, either that or they were so large and they ran out of liquidity and they were the reason that the thing spiked. And that very well could be that they exacerbated the whole move upwards. I don't know how big the account. Like, he wasn't managing that much. It was a couple $100 million or something is what the rumors are.
But see, I look at it because in the way I look at the markets, I look at always not from a percentage, but I always look at it from an account size. So, you know, if I'm trying to do a yield enhancement and I have $1 million account and I'm turning around and say, I'm going to use these naked calls on nat gas to give my performance a kick, right? Now, if I just sold one naked call, and I kept rolling that on a month in, month out basis, harvesting 2% return on every 1 month call that I write, then, you know, you might turn around $2,000. Let's say you're making $2,000 a contract. You collected $20,000, $30,000 by the end of the year in premium. You just given your performance on $1 million account a 3 to 3% kick. See, that's diversified. You did it on one naked call contract. You did it as a little yield enhancement. But like, this is not yield enhancement. This is not like he didn't do this on one naked call.
Yeah, no, he must have been just balls to the wall.
Balls
like all
to the
in.
wall.
Like there's
balls to the wall.
I'm just really curious like how well he was doing beforehand because you know, assuming this sort of volatility like on the losses, I'm thinking the plus must have been great as well. Like
But clearly the for sure the performance looks great until it's not.
That's right, and that's the thing about shorting vol is that's the way it works, and it just you make. You
got to know when to walk away.
Yeah, and it's a difficult.
What was interesting. Last chart I want to show, and you can keep going with your point, but I wanted to just actually just show. What happened to the implied volatility on nat gas? And this is we were saying that this is not a big factor for because
that's right. We were laughing because that's Vega, which is your sensitivity to the implied volatility. But if he was short and the move was so much that is actually
he blew through his Vega.
He blew through his Vega, and it's all delta, meaning that it basically became 1 for 1.
It's the intrinsic value of how much he's in the money.
Because he's $1 in the money or whatever. So exactly. It doesn't really matter. But unless he was short all sorts of long dated stuff, but I just don't see that being his strategy. There is a chance that he was shorting all sorts of long dated volatility, and then his Vega would have been higher, and he would have been having some trouble. And you never know. We don't obviously know the position.
We don't know.
But let's pull the chart up again because it is amazing, like to get a feel for the craziness of the move over the last.
We went from a 40% implied to 110%,
and that's on a commodity.
On a commodity,
and that's crazy. Like very rarely do commodities get 100%. Like we used to laugh when stocks every now and then there'd be one stock that would trade at 100, but a commodity is generally a lower.
Well, what was it? It was Tilray that had like the
300
or 400% implied.
They're definitely, but a lot of times those are just the near term.
Yeah,
ones
of course,
the
near term
ones.
Yeah, of course.
But
it's always front month.
Yeah. So, but this is just It's an incredible story. It really is. It's going to be one of those ones.
You know what? I feel for the people that got hurt, but you know what? Him trying to be sympathetic to these people, saying that you're family. You know what? I'm sorry. That kind of risk, that was irresponsible. That you don't treat family money.
Not only
way.
that, when I have something bad, tell my family I don't do it via YouTube. So
Fair
that,
enough.
and you know what? One last thing I'll just a parting note is that I'll tell you is that I remember talking to one of my buddies who was a commodity trader, and he told me a year or two ago that there was all sorts of this stuff going on, and that everyone around him was short volatility, and they just kept earning it. And this is a function of the quantitative easing, dampening down volatility, and making people search for yield in a lot of different places. And I suspect that this isn't the last of these stories, and you're going to find more of them going forward.
I'll agree with that. Let's move on.
Okay, so for this week's Tales from the Trading Desk, Patrick, this is one that's dear to your heart. It's and I actually love this story as well.
I love it.
It's Carl Icahn versus Ackman. And it's a famous one, Herbalife. So let's just start. You pulled up. There's actually a movie on that was created about the whole kind of
2 hours of movie.
That's right. So let's just play the trailer for everyone so they get a feel for it.
What are we going to learn? You're going to learn why Herbalife is going to collapse.
Bill Ackman is on a holy war.
A couple times we come across a company we think is causing harm. We can make money betting against that company.
Herbalife stock goes down, we make money. Herbalife stock goes up, we lose money.
And that's short selling.
How much money have you spent betting against Herbalife?
Over $1 billion.
What are you accusing Herbalife of?
Of being a pyramid scheme.
This is a legitimate company. That's a bogus accusation.
Multi-level marketing. They tap into beliefs we have that you can accomplish whatever you want to.
The wildest dreams you've ever thought of can come true in Herbalife.
They took my dreams, my hope to be successful.
Yo perdí $16,000.
Estaba invirtiendo $1,600 o más.
$22,000. The kind of people that can do that, I mean, they're crooks.
Carl Icahn, the famed hedge fund trader, taking out a big stake in the company, pretty much because he hates Bill Ackman.
Since then, we saw the stock double.
Ackman is a liar. He was like one of these little Jewish boys crying that the world was taking advantage of him.
He essentially could crush Ackman short.
I bought it because I really think it's a good product.
He's not there because he believes in Herbalife's product. He's doing it because he thinks he can make money by squeezing Bill Ackman.
This industry is going to continue to burn people.
We haven't penetrated the markets and communities anywhere close to what we're going to see. And you, with us, it's family, and nobody messes with the family.
Okay, so Patrick, why don't you give us a little bit of this Tales from the Trading Desk, kind of fill us in what happened and walk us through how this trade worked.
So Bill Ackman, looking for his next big play, zeroed in on this Herbalife and this idea that he could take down the company as a pyramid scheme. And he quietly began a very active short-selling campaign. Essentially, in the end, he ended up shorting 37 million shares, which is 35% of the outstanding float.
And like just brain dead. Like he shorted all this, and then what did he do? Like that's just like this next part just kind of amazes me.
Well, he advertised it.
I know. He got up and he actually went. Didn't he do it at a conference?
Absolutely.
I think he did. He got it at a conference and he talked about how this was such a, or maybe, no, wait. I think he actually announced it on CNBC. I think he did more than, anyways, regardless.
He made it very public because, well, think about it. If you're trying to expose it as a pyramid scheme and you want, well, think about it. His whole goal was for the Fed to come in, investigate the company, expose it as a fraud, and they shut down the whole company, and he never has to return the stock. He just, the borrowed stock, he basically zeroed out, and he gets to keep all of the profits. So he was betting on zero. That's the name of the movie. That's right. Literally what he was doing. He was all in on the fact that he was certain he could bankrupt this company.
But to go and to expose yourself, to expose a flank like that, and some shrewd operators kind of saw that, and
it's amazing because you have to go back to read the book, like The Reminiscences of a Stock Operator, to really get a feel for the types of shrewd kind of whale traders that are out there that love to play this game against each other, cornering markets and doing all of these types of games. And by him advertising this, while he is certainly, he sort of had to make the assumption that he was playing a game against the company and against the government, which is that he needed the government to come in on his side. But what he clearly did not account for was the one additional variable, right?
That's right. And that's Carl Icahn.
And
to be fair, actually, although we're talking about Carl Icahn, there was actually another guy, Dan Loeb, did it as well.
Well, see, Carl Icahn, I think, is buddy with Loeb, and I think that they did a tag team. There was actually, I think there we didn't look up the names, but I think there was like 3 or 4.
Well, and you know what's even funnier is that Loeb and Ackman are buddies as well. But clearly, there's no love lost when it comes to business, right?
It's just in dog eat dog.
That's right.
It's a lot of people are retail investors, and they feel like the big guys are out to get them. No, the big guys are to get the big ones. Like they want the trophy on the wall. Like that. You don't want to go after the little minnow. You don't put a minnow onto your wall as decoration. Right. You want the big trophy.
Yeah. So although Loeb might have been involved, it was really Ackman that led the fight in terms of.
You mean Icahn?
Sorry, it was Icahn that led the fight against Ackman in terms of trying to skewer him and put that trophy on the wall. So why don't you tell us a little bit about it?
Well, really, what it just came down to is that Icahn, being a veteran of this, knows when somebody has put themselves in a corner. Right, he knew that Ackman had no out. He had no out. Like if he failed at being able to identify this, that he was going to be forced to have to cover his short.
Right.
Right, and in doing so, he knew that there was simply, with 35% of the float, there was no liquidity for him to be able to buy that in.
Right. And so we were actually chatting a little bit about the short sale market and like the borrowing market. And it was actually interesting because I think a lot of people are not. There we go. We can see we have a picture of Icahn and Ackman in a headlock. I think a lot of people don't understand that the market to borrow shares is kind of a wild west of financial markets. It's not something that's done on an exchange. It's not something that is done with a set of rules and regulators doing it. It's basically you need to borrow shares to short them, and you need to make sure you have that supply. And one of the things that you can do is you can actually get recalled. Like sometimes when you short when you short a stock, you can get a situation where it gets called back from you.
Yeah.
And not only that, it's not a rate that you guarantee. Often it's something that it floats with the market, meaning like there is a bid and offer based upon the supply and demand, but it can actually vary, and it's a relationship based. And one of the things that we were discussing is that Icahn went out and bought some shares and to squeeze them, but he also could have been going out and actually borrowing shares. And even though he wasn't short, he could borrow them and squeeze the cost for Ackman to hold that short. And that's something that people don't really understand, is that another whale can go out and actually cause your short to go up in price.
It's the guy with the most amount of money.
Yeah. And so that's why most hedge funds will not tell you their short positions. You go look, very, very few hedge funds. They will tell you all day long. They will advertise their longs, and they will go and they will kind of pump them up, but they will not go and tell you the shorts positions. And this was just...
especially when it's that big. Like, I mean, this, a lot of hedge funds, they'll be diversified on their shorts. They're not going to do a position where they are going to be in a liquidity trap. Because what a lot of retail listeners don't understand is that retail investors can pretty much have a easy market to get in and out of the positioning. But when you listen to the really big money players, the one word that they're always using is liquidity.
Oh, yeah.
Is that in equity markets...
They take weeks and sometimes months to get in and out of a position.
Because the liquidity just isn't there in the stock.
Well, think about like Fidelity owning Tesla. If they want to sell, like let's say tomorrow they got bearish on Tesla, they might have the stock selling it because they own such a large position of it. It would literally take them probably a month, and it would probably cause the stock to get halved. And so a lot of times they're playing for the longer term, and they don't have the luxury the retail does of just going, oh, I don't like the position anymore, I'm going to get out of it. That's not the case for these big whales.
And so really what happened was Icahn, Dan Loeb, and all of these guys basically got together and they started buying down. And you know what's amazing? It's not whether Herbalife was or wasn't a Ponzi scheme. It wasn't whether or not their business model was good or wasn't good. It had nothing to do with the company. This was all about the dynamics of the markets. And what they knew was that Ackman basically made a massive blunder. And they all realized that they had an opportunity to make enormous profit on basically squeezing them.
And it's
so I want to show the chart.
Because it's a great story, and it just goes to show you that
this is true history, right?
Yeah.
I think that one day we're going to see a real movie about this. Now I know Scott Wapner wrote the book on this already, and obviously there was this movie Betting on Zero, but I think that there's going to be an actual drama.
Oh, do you?
I think this is a great Wall Street story. Come on,
pick some guys. Who's going to play Ackman?
I'll have to think about that one. But,
well, okay, let's show the squeeze. Let's show the extent of the squeeze.
This was, I think that this right here represents where the actual announcement came that he shorted the float. Right, so I think this entire drop right here in 2012 was where the first announcement came, and he basically took the stock from $37 down to about $12. Like at that time, he looked like he was about to walk away like a rock star, on having shorted this thing, but he had no out.
That's right.
And what was the thing about being down to $12 a share? There became almost no risk for Icahn to take the other side of this.
Right. So is that where Icahn started?
Well, I don't know if it was at $12, but it was definitely down on the bottom end of this range going into 2013. Because he bought the 2000. Now he entered with some options. We were debating this extensively about the relevance of his option, but positioning. But he went out and did May 2013 and January 2014. Options for something like 11 million call options, and he sold the respective put options, creating a delta 1 position.
Right, it was a synthetic long.
It was a synthetic long that he built in.
A lot of hedge funds, just for people to realize to know, is that a lot of hedge funds don't actually like owning the stock, and they will do synthetics or swaps to achieve the same kind of economic benefit as owning the stock. It just makes things cleaner, or it might be from a regulatory
reporting perspective.
Who knows? There's a million reasons.
Yeah. And so the point being is that once Icahn got in here, the stock basically reversed from a low of $12. I don't know what the day he announced that he was buying, or whether that V bottom really was because of him. But we found that the stock basically doubled from $12 to $24 in the weeks afterwards, and it consolidated down around this $20 range, and then the squeeze really played out. I mean, the stock basically went from the $12 low to $42 in the span of the 2013 year.
Yeah, like more than tripled.
Oh yeah. from the low, and more importantly, at the 42 mark, it was now higher than where Ackman actually accumulated his short position.
That's right.
And so now he's losing money. And that was crazy. I'm going to switch this from a daily chart to a weekly chart, because what happened in the next few years is pretty crazy too. What happened was that this stock basically, after this whole event, rocketed. I mean, right now the thing hit $60 a share. Right? And
crazy. So Ackman was wrong.
Or he was squeezed. But what is interesting about it all was that he attempted to take down the company. End of story. He tried to bankrupt the company. Whether you agree that Herbalife was a Ponzi scheme, and whether it was a pyramid scheme, and whether it was a thing, the bottom line was that Ackman was not in a position to risk the capital of his firm to continue to maintain his crusade. So what's interesting was he had to save face. And so how did he do it? He actually went to the market makers, right? And he basically converted his short sell into puts.
That's right. So he could limit his loss.
Right.
So at that point, he's tapping out, because he's looking at it. He's like, this could, I got squeezed to 45. What's there?
So after 2012 all the way to 2017, a 5-year public shaming. He basically, on November 1st of 2017, basically threw in the towel, and essentially he converts his entire position into a short position, into just an outright put option on the market, and still gets squeezed out of it. Limited his risk to 3% of the capital of Pershing, and still gets shellacked for that on top of that.
That's right. So it's just a disaster. And not only that, how about the egg on your face on a kind of...
For a guy that has, he had a lot of successful trades, and he built a very strong reputation for himself.
Well, he's had some trouble lately, and there's been a lot of...
No, we're talking about beforehand.
Yes, that's right.
And basically this started the thing where his investors suddenly realized that he's human, and not he's not like some investment god, and now...
Even though he will tell you he is.
Anyway, any last comments?
Well, no. We'll finish with a little bit of the video. We'll just throw it out, because part of the reason that Icahn was doubly happy to go after this Ackman in this situation was the fact that they had previously had some history, and so we'll just leave you with a little video of a famous CNBC feud that they had.
Again, I think this is not a great use of CNBC airtime.
Well,
what I can tell you is this is not an honest guy, and this is not a guy who keeps his word, and this is a guy who takes advantage of little people. That's what
let's make good use of it, or better use of it then. Carl, why don't you just come clean on the Herbalife thing? Are you long or not? Right? I mean, the whole market knows or suspects that you are.
I didn't get on to be bullied by you, okay? If I could talk, let me talk, but I don't need you to... Hello?
Yeah, I'm here. No one's bullying you, Carl. I mean, I'm just, you're the one who called in to our show to talk to Bill Ackman, and the principal issue is the Herbalife thing.
Listen to me. I was called in by Max Meyer to have a conversation, not to argue with you. All right? If you want to take... Hello?
Yeah, we're listening.
Well, if you're listening, let me talk. I want to say what I want to say, and I'm not going to talk about my Herbalife position because you want to bully me. All right?
I'm not bullying you. I'm asking the question everybody wants to know, Carl. That's all. But you can make your statement.
What you want to know. I'm going to talk about what I want to talk about. And if you want to take that position, I'll never go on CNBC, So you can say what the hell you want, but I'm going to tell you, I'm going to talk about what Ackman just said about me, not about Herbalife. And I'll talk about Herbalife when I goddamn want to, not when you ask me.
Okay.
I'm never going on a show with you again. That's for damn sure, okay? So let's start with what I want to say. Ackman is a liar, okay? To begin with, I've lived my life from 1960s to 70s by handshakes. I almost lost my firm a few times by handshakes. Ackman does pump and dump. He's got one of the worst reputations on Wall Street. And I'm going to tell you this Herbalife is a classic example of what he does. let's look at Herbalife. Ackman was doing badly in 2012. He was down 2-3%. He probably woke up in the morning and said, let's see what company we can destroy and put out a bear raid on it. It's happened from the late 80s till now. And go do a bear raid, kill the stock, and now we can show our investors we made more money. And by the way, if we can mark these things and make more money, he says that he's not taking the profit, but that gives him a better rate of return for himself. Ackman has done that. If you read the articles about him, he's done it all his life. And I will swear to you, and I don't need, we didn't make a lot of money on this goddamn crazy thing I did with him. We made $4 million, but I was incensed because I will tell you that without question, I will swear to it on any Bible you want that I had a verbal agreement with him that he was not going to get any piece of the money. And at the end, he was, as he said, he was in major, major trouble, and he's basically lying.
Okay, we've now reached the point in the show where we're going to go over the top 5 things to watch from last week and see how we did. Let's start with number 5, Patrick.
Well, I thought it was rather important to watch out for the Bank of Canada and the ECB financial stability reviews that were coming out. And, of course, the source from which I used to see that they was published.
Don't mention names.
I won't mention any names from Forex Factory. But ultimately, the reports are not out yet. So it was the number one thing for me to watch, which never happened.
Well, Patrick, it might have been number 1 for you to watch, but I think you were alone, and you were lucky to get it in the top 5, and it didn't even happen. It was a fitting end to a terrible choice. Okay, so let's go to number 4. Mine was the high-yield credit spread blowout. Would it continue? And the answer is yes. Much to everyone's chagrin, credit still is on offer. It doesn't seem to have any end in sight. The GE keeps widening. All sorts of problems in credit land. As I mentioned before, Scott Minerd and Paul Tudor Jones are both kind of sounding the alarm sounding the alarm bells, and things are a problem in credit, and we should keep our eyes open on that.
So number 3, I was looking at that biotech, the IBB, and whether that support would hold. Well, surprisingly, in spite of the weakness last week in the markets, we did not see a break of that kind of 101, 102 level. It doesn't mean it won't happen, but at least the selling that we saw this week that was breaking the market down wasn't enough to cause the support line to give out. What was number 2?
Number 2 was the European PMIs, and I always kind of like to focus on Europe a little more than you do, and they were terrible. And we saw that today. Actually, we're recording this Friday. We saw it today with the fact that the Bund is up 50 cents kind of, and the European PMIs are just terrible. Like, I'll just go over just briefly. The entire Eurozone manufacturing PMI was expected at 52. It came in at 51. I see that France, the manufacturing was supposed to be 51.2. It came in at 50.7.
I'm going to interrupt you because I just want to, for our listeners that are not familiar in tracking PMIs, what we want to know is that if it's dropping below 50, it's a contraction in the economy.
That's right.
And so they tend to peak out maybe as high as 60. Is that right?
Yeah. The real important thing to realize to watch for is the fact is the economy growing or is it contracting? That's right.
Rate of change.
Well, not only that, the 50 level is a big deal.
Yeah, it is a big deal.
And these are more and more of them are close to 50, and it's showing all sorts of pain in Europe.
That's enough for my interruption. So what would the numbers come in at?
Well, there was just all of them were like that. The Germany manufacturing 52.2 was expected 51.6. The Germany composite was 53.1, 52.2. So basically just across the board, just crap. And that's the official economic.
There was a zero hedge piece that picked up one of the major investment banks that basically were calling for flash recessions in Europe, in both Germany and in Italy. This idea that Germany could see a contraction in their GDP and Italy would be zero out. But what's interesting about that is that we haven't actually seen Mario Draghi begin any real tightening. I mean, he's just actually taking the punch bowl away. He hasn't even actually started to.
He might never get his tightening before he leaves because he's scheduled.
Are we going to see negative interest rates perpetually in Europe?
Well, I sure hope not, because I think it's the negative interest rates.
How do you avoid this? How do you avoid this?
Well, fiscal, but we shouldn't go there because the reality is that's a whole other show. So let's go on to number 1. What was the number 1? from
obviously last week it was whether the S&P 500 was going to hold that 2,680 level. It was a fib level that we were watching that could have turned the market, and boy, was that level taken out with some velocity. I mean, we're trading right now back down to the October lows. And you know, if we give that out, then we're going back to February lows. And
there we go. True technician. If it goes lower, it's going to keep going lower.
Oh my God! You like every show you're going to call that one out. But you know, a true technician. but let's be realistic. If it breaks that level, where else is it going to go?
Well,
look, the bottom line is it didn't hold, and the S&P continues to sell, and there's active distribution. One thing that I'll just make very clear, which is that we have in the last many years seen that every situation like this has led to the buy on dip traders showing up, and they scoop up the market with as soon as they got a bargain. There is no sign of buy on dip at all.
I would agree. The nature of the market has changed. Now, the fact that we're both agreeing on that probably
is a dangerous thing.
That probably means it's time to buy with both fists.
Well, listen, I will say this. A very natural counter-trend retracement is 100 S&P points. And so at any one moment, we could have 100 S&P point pop, but I don't think that changes the trend. At this stage, it's for me, there's something in motion. We could find ourselves temporarily at 2,700 and it won't change anything. But let's see what happens.
Okay, so let's move on to the top 5 things to watch next week. Patrick, what do you got for number 5?
Number 5, we are watching the Euro USD. More importantly, you were talking about the weak PMI numbers that came out. The euro broke. Now, I mean, I know that in the bigger picture, you think that the US dollar is going to eventually break. But right now, the euro weakening is the path of least resistance, especially if everyone's realizing that Mario Draghi doesn't have any bullets. And what we see here was that the initial reaction was a breakdown. We're at the 113.57 level. But these lows between 112 and 113, where we were at the start of November, if we see that level broken, I mean, we could be heading down to even the 105 level on the euro. Now, will that happen? We'll see. But I think this week, watching whether or not the selling comes down back to those lows and whether this is sustained is definitely something I'm watching.
Well, that sounds good. That's a much better 5 than last week's 5. So let's hope for the best. Okay, so for number 4, I'm watching GE spreads. And by spreads, I mean the credit spreads on their bonds. So what I'm watching specifically is how these GE bonds are going to trade. There's $111 billion of GE credit out there. I think that it is the kind of stalwart of credit that you should be watching. It is the canary in the coal mine. Is this going to get worse? I think that we need to see these bonds. They're already trading like junk. We need to see them stabilize and head higher before this market can actually bottom, meaning the whole stock market. So for me, I'm looking at the GE bonds as kind of a foreshadow of where the whole market is headed.
Number 3, I'm going to be watching NVIDIA and whether it goes back to its 2017 lows. Now, what a story this was. I mean, we were trading near 200 and actually we were trading at 290, near $300.
It was the darling of the stock market.
It was, and wipes out 50% of its value in a month.
And just the chart looks like death.
It looks like death. What's interesting is that there's a big consolidation on this chart down around $110 where it consolidated from that kind of February to May of 2017. So to me, that's still $30+ away. I mean, the fact that this chart the stock is so incredibly weak, do we see follow through selling? I know a number of people on Twitter that have been already suggesting that is due for that mean reversion, but is it the same type of mean reversion as crude oil where like you keep thinking it's coming and the bleeding just continues? I mean, at this stage, it's a pretty bold thing to try to fade this.
Now, do you think, what's your prediction? Are we going to see that? Are we going to hit that critical support point?
I think there's going to be a strong correlation to the NASDAQ. I think that if we continue to see the S&P and the NASDAQ drop 100+ points on the downside, yes, I think we will. But I mean, I think that at this moment there's going to be a correlation to the indice.
Fair enough, but no catching the...
I'm not catching this falling knife. Maybe I should be, but I'm not.
Okay, let's move on to number 2. Will the crude oil pain ever stop? It's just another day. We got up today. It's Friday. The Americans had Thursday off, and they came in and they decided, you know what we should do? I don't think crude oil's been down enough. Let's sell it again. Let's go down another 5%.
It's a half-day trading day, right. Black Friday. Let's...
Do you know what's amazing is that Trump somehow believes that this is going to be positive for the American economy. He's like actively cheerleading it down. And now I understand that they are a slight net importer, but I think that he's mistaken that the days of the Americans being a huge net importer are gone, and that this is causing a lot of pain for a lot of parts of America.
Okay, but where crude oil is one thing, but what's interesting is that this drop has happened also in gasoline futures. This gasoline drop has been a 35% drop in gasoline prices in less than 2 months. And if you go from the peak of $2.30 back in the summer, that's almost a 40% decline in a half a year. Like this, while you can talk import or export of oil, this is stimulative for economic consumption, is it not?
Well, you're probably right in the long run that it is. In the short run, one of the things is it's going to be a question of whether the Fed monetizes this or not, because this is actually going to cause deflation, or at least disinflation, and it will cause it in a kind of absent anything else. The Fed should be actually lowering rates on a relative basis versus what they would have done if had oil and gasoline stayed up there. So if the Fed monetizes this, which, coincidentally, we're seeing Trump leaning on the Fed in a huge way. Like every single, week he rails at them how they want he wants lower rates. So it's stimulative. It's also disinflationary, and it also could cause the kind of deflationary vicious circle that we're worried about. So it's kind of complicated is the answer. But in the long run, you're right. Energy goes into the cost of producing everything, and by lowering the price of it, it's making it much more kind of economically strong.
So back to the point though. Is 50 a threshold? Are we above or below 50 next week?
Well, every time we've done this, we say this and we get...
Eventually, a broken clock is right twice a day,
what?
Right?
The best thing could be is we say, we've given up, and that's the point where you got to buy it.
So have you given up?
No. Have I given up? No, I have not given up. And
so it's going lower. Okay.
So it's going lower. There you go, folks. Okay, so let's move on to number 1.
So number 1, we're going to be watching that G20 meeting in Buenos Aires, where obviously all the world leaders are getting together. What's your thoughts on it?
Well, I think it's a big deal because we've had all sorts of trade tension between Trump and Xi Jinping.
Yeah, but okay.
Okay.
Close enough.
Yeah, close enough. Boom, boom, pow. But Xi Jinping, the Chinese leader, and... there's been all sorts of difficulties in terms of, trade tensions that have caused the markets to sell off. And the real question is, at this point, how much is baked in? Is the market prepared for a no from this summit? Like, what happens? Does that cause the selling to accelerate? And not only that, what are the chances that the two of them come up with some sort of agreement that doesn't really accomplish much? Because don't get me wrong, I actually don't think that there's going to be a real agreement. But will we see a situation where, at the very least, the kind of escalation of tensions will kind of subside? And I think that's the best that we could hope for. And if that happens, does the market rally from there? I would probably guess that would be the case, but I don't think that it'll be a real substantive kind of solution.
Let's see what happens next week.
Well, Patrick, we've reached that point in the show where we're going to leave the viewers with a little bit of trading wisdom, and this week's comes from Paul Tudor Jones. And we mentioned him a couple of times in the show, and it's this is one of my favorite quotes from him, and let me just let Paul tell you about it. So, don't be a hero. Don't have an ego. Always question yourself and your ability. Don't ever feel that you are very good. The second you do, you are dead. And I love that quote. It's just a terrific quote. And
it is. And you know what? When you think back, look at the people we just talked about today. James Cordier, Bill Ackman. In the moment you get cocky, in the moment you think you're on top of the world, the market is always bigger. The market has always got a way. You have to have humility. You have to know how to cut your losses and hedge your risks.
I look at my biggest errors and my biggest losses, and they've always occurred when I've actually thought I know something. So. Thank you for spending some time with us. Please visit us at markethuddle.com to sign up to receive our weekly email that will include a link to the show and the charts that we discussed. Rest assured, we will never clog your email with junk, and we will only send you our weekly letter and updates for our upcoming shows. Also, please follow us on Twitter at The Market Huddle. For those listening on a podcast and would like to view the charts we discussed on the show, please visit markethuddle.com, where the full video for the show can be found. So, on behalf of myself, Kevin Muir,
and Patrick Ceresna,
I'd just like to say thank you for listening. We'll see you next week.